More and more people are drowning in debt today. People have school loans, credit card debts, personal loans. They're taking loans out against their 401ks. People are drowning in debt. Now, if you own a home, there are 3 ways that you could use your home to get cash to help pay off that debt. But none of these ways is perfect. Hey, what's up, everybody? Like I said, everyone has some debt nowadays. Some people are really drowning in debt. Some people are really trying to cut expenses and cut their costs, trying to get out of debt. But if you have a house, there are 3 different ways that you could use your house to help you get out of debt. Now, as a former real estate appraiser, it makes me nervous even talking about this, because for years I saw people using their houses as piggy banks, constantly tapping into their house, the value of their house, to pay off debt, but not always paying off debt, but buying a new car, buying this, buying that, spending. So it's very tempting for people who are in debt to get a lump sum of money and then actually use it to get out of debt rather than spend it and get themselves into even more debt. So I saw this often as an appraiser, and it can be very dangerous. But these 3 methods of using your house to get cash can absolutely help you get out of debt. You just have to be careful. So let's take a look.
1 is a home equity loan, 2 is a home equity line of credit, and 3 is a cash out refinance. First up, home equity loans. Now, these are second mortgages typically set at a higher rate than your first. It's for a fixed amount at a fixed rate over a set period of time, typically over 20 years. This could be a good option if you own a large portion of the home outright and you need to cover the cost of a big ticket expense. Meanwhile, a home equity line of credit is more like a balance of a credit card. You get approved for a set amount of credit, but you do not need to borrow all of it. This could allow you to fund a long-term project or higher education costs. Now, with this option, interest rates do vary with the prime rate, though some lenders will allow you to set a portion of it at a fixed rate. Finally, a cash out refinance. Now, this replaces your current mortgage by refinancing for more than the outstanding balance, and you can take the difference out in cash. This could be an option if you can get a lower or comparable rate to your current one and you need extra cash for a single large expense.
So let's talk about the home equity loan first. The home equity loan is exactly what it sounds like. You're taking a loan out against the equity on your house. Now, how much of that equity you can use is going to be up to the lender. Let's say you have $100,000 in equity on your house. That doesn't mean you could take out the full $100,000. You're probably going to be capped at maybe 85% of that. Typically, it's going to be around 75%. But let's take a look at the pros of a home equity loan. As you can see here, you're going to have a lower interest rate. The interest rate is going to be slightly above that of a regular mortgage. You're usually going to be around a sort of prime plus 2 points. Whatever the prime rate is that a lender can borrow money, you're going to pay about 2 points on top of that. And you're going to get all your money at once. It's lump sum funding. So just like when you buy a house, you get a mortgage, you're going to get a lump sum of money. Now, like I said earlier, this can be dangerous. I mean, you want to use that lump sum to pay off the bills you have, whether they're credit card bills or medical bills. You don't really want to use that money for anything other than getting out of debt. Remember, that is the whole purpose of this. Now, they have listed here potential tax deductions. Okay, so you might be able to write off some of the interest paid on the loan to limit your tax. This is usually not going to be a whole lot of money unless you're in the highest tax bracket possible. Improving your credit score is kind of ridiculous to list here because just paying your bills on time improves your credit score. So there's no reason to get loans just to pay them, which will improve your credit score. It doesn't make any sense. It is flexible. Okay, how you use your money, that the lender's not going to tell you what to do. They're going to give you a lump sum of money, which is different than, an auto loan or a student loan or a loan that is for one specific purpose. Now, of course, with that list of pros, there's a equal list of cons. Let's take a look at those. So right off the bat, okay, you're using your house as collateral. That's why the interest rate is going to be lower than, let's say, the interest rate on a credit card. But that also means your house is at risk. So if you can't pay off your home equity loan, you're going to lose your house. You're going to go into default. It's the same as if you went into default on your mortgage. Some of the qualification requirements are a little stringent. They're going to look at your DTI, which is your debt to income ratio. So your overall debt is going to be one of the criteria here in terms of qualifying for this, as is the amount of equity you have in your house. Costs and fees are listed here. Okay, this is a loan like any other loan against your house. You're going to have to pay an application fee. You're going to have to pay for an appraisal. You're going to have closing costs, just like a mortgage. So let's say, for example, you can take out 50 grand. Well, when you put all those costs in there, you might only be getting 40 grand. So keep that in mind. You're rarely going to get a fee-free home equity loan. Fluctuating home values, okay, that could affect it over time. And there are some risks with debt consolidation. Using the loan to consolidate higher interest debt seems appealing, but it may not be. You need to look at the interest rates, and you need to look at, is it really worth it in terms of putting your home up as collateral for the loan? Now, the next one we're going to look at, I'm going to skip ahead to the Cash Out Refi. So let's take a look at the Cash Out Refi pros list. You get access to a large sum, very similar to the home equity loan. You get all the money at one time. The interest rate is going to be comparable to a slightly above the prime rate that you would get on a mortgage. It's going to be considerably less than a credit card or a personal loan. Your payments are predictable. Okay, that's nice. You're going to have a monthly payment. All of these have predictable payments. You might be able to write off some of the interest. Probably not going to be as much as you may think. The boost to your credit score, that's the dumbest thing to list there. It's like saying you should go into debt just to boost your credit score. Let's take a look at the Cash Out Refi cons. So the big con, you owe more because you're taking out a larger loan amount. Okay, your overall debt load is going to increase. So it doesn't matter how close you were to paying off your mortgage, the cash out is going to raise your debt level. Second, you might be kicking your debt down the road. If you're cashing out to pay off a credit card or some other high interest debt, take a long pause. Make sure you've addressed whatever spending issues led you to run up debt in the first place. Okay, thanks for the advice. Another con are the closing costs. Just like all these, you're going to pay considerable closing costs, and you're going to have to get an appraisal and all that other stuff as well. And of course, there's foreclosure risk because, again, the loan is tied to your house. Now, the third one that was mentioned in that clip, the third way to tap into your house in order to get cash and pay off debt was the HELOC, the home equity line of credit. And of the three, this is the one that I am most in favor of. Let's take a look at the HELOC.
Keeping up with the housing market, the use of home equity lines of credit or HELOCs is on the rise. Cash-strapped Americans are using this type of loan to help pay down their debts. Here with more is Yahoo Finance senior reporter Claire Boston. Now, Claire, before we get into what is really happening here, can you first explain what a HELOC is and why more folks are turning to that?
Right, so a HELOC stands for a home equity line of credit, and it is sort of like a credit card based on your home. It's backed by your home equity, and it is a tool that consumers can use to do things like have renovations, consolidate their debt, and it is in addition to your mortgage. So it is a second credit line. It typically has a higher interest rate, but it's an appealing option right now for a lot of people because they have mortgages that are maybe 3%. They don't want to refinance their mortgage, but this is a separate credit line that can still allow them to tap equity in their home.
Are there any risks of using a HELOC? Because as you said, it's sort of second to a mortgage, so more debt, essentially.
Right, it is more debt, and ultimately this is debt secured by your home. So you have to make sure you're going to be able to make those payments. In a worst case scenario, the bank could end up owning your home.
Mm-hmm. With the Fed lowering interest rates, does that have anything to do with why HELOCs could be on the rise, or do you anticipate more Americans to go towards that option?
Right, so HELOCs are based on the prime rate. So when the Fed drops interest rates, HELOC rates drop too. They are higher than a conventional mortgage. Around average right now is 9% or so. But if the Fed continues to cut and we see mortgage rates and prime go down, we would also expect HELOC rates to get lower.
Okay, so something to watch as the Fed continues its easing cycle. But Claire Boston, thank you so much. Appreciate it.
So because real estate has gone up significantly in the last 5 years and interest rates have come down a little bit, home equity lines of credit are making a comeback. They used to be all the rage many years ago, but then when the market started going back, lenders pulled back. So lenders weren't as freely giving out HELOCs because people were abusing them, taking all the money out, spending it, and ultimately getting foreclosed on and losing their house. But the HELOC, it's making a comeback, and it's a really good thing because it's very flexible. Fees are often a little bit lower, and it's basically a revolving line of credit on the equity in your house. And you don't have to use all that money. It's not being forced upon you. Whereas the other two, you're getting a big lump sum of cash and you're thinking, okay, I'm going to spend this, hopefully on credit cards and paying off debt, but you're also going to pay interest on all that money. So if you don't need all that, you don't necessarily want to take all that. But any lender is going to, they want you to take as much of the loan that they give you because they're going to make interest on it. The HELOC is different. They're going to give you a revolving credit line up to a certain amount, but you don't have to take all that money, which means you could save money on interest. So let's go right to the pros and cons list of HELOCs. So as the pros, you can see it has a lower interest rate. Okay, this is going to be lower than your credit card. It's going to be similar to a home equity or a home equity loan. Okay, you're going to pay usually 2 points above prime rate, but it's going to be far less than what a credit card is going to cost you or a personal loan. Very flexible. And some of the interest might be tax deductible. Now the cons are that, okay, you're going to have variable rates, your payments are going to fluctuate, but that's all on you. It depends on how often you use it. It is tied to your house, so that's a con, but being tied to your house can be a pro as well because that's what's going to keep your interest rate down. Okay, if it's a secured loan, you're going to pay a lower interest rate. If it's a loan that's not secured, like a credit card, then you're going to pay an extremely high interest rate. It will limit the equity cushion in your house. That is true. And it does have the potential to run up a balance quickly. Now, that is the most dangerous thing. So this is something where, again, you get the money out to pay down debt. That's it. Do not use it to buy a new car. Do not use it to take your kid to Disneyland. You're just going to take on more and more debt. The only reason to get something like this is to pay off debt that has a higher interest rate. So you can eventually get yourself out of debt completely. Now you can see here that they carry fixed or a floating rate, which depends on what the prime rate is. And that's going to fluctuate, whatever the Fed, they change it from time to time. But like credit cards, HELOCs, it's revolving credit. Okay, so you don't have to tap into the entire amount. You can use some of it, which means you only have to pay interest on some of it. There's what's called a draw period, which used to be 10 years. Now lenders have kind of cut that back somewhere between 5 to 10 years. I'm not sure if there are many lenders that still go up all the way to 10 years. But that's when you could draw the money out. And then you have to start paying that money back. So the draw period closes, and then you have a repayment period, which can be up to 20 years. And again, that is going to fluctuate on the lender. So it could be considerably less than 20 years. Now, there was something really interesting in this article, and I clipped it. And here's what I'm talking about. This guy, Espinosa. HELOCs are like fire. Okay, that is 100% true. They can help you progress well if contained and managed well, but they can also get out of control and be a detriment to one's financial situation. So what he's saying is that if you get this money and your eyes get all big and you think, oh my God, I have all this money now, I can go spend it, then you're defeating the entire purpose of getting it. Because essentially it's a credit card. But the credit card is tied to the amount of money you have in your house. Now, if you have a lot of equity in your house, then the limit's going to be very, very high. And not everybody should take on a credit card with such a huge limit. if you're a spender and if you're already in debt. So you want to use it to pay down anything like a credit card or any other personal loan you may have that's, of a considerable interest rate, let's say. So the bottom line is that a HELOC can be very beneficial. If you have stable income, high credit score, if you want a line of credit that you can draw from as needed, let me emphasize that, as needed, I don't think you should use it to make improvements to your house. And the tax benefit is not going to be huge, so I wouldn't even be thinking about that when I applied for it. And they have risk, okay? Variable interest rates, you're not necessarily going to know exactly how much you're paying back at any given time. It's not like a mortgage where everything's locked in. So it can be tough to budget your repayment, and securing a loan with your house also can be risky. But using only the amount you need and then paying it off and closing out the HELOC can be very beneficial. And as an appraiser, I did have experience with a lot of people who would take out HELOCs and use it exactly for that reason. And it helped get themselves out of debt by paying off that really high interest debt like credit cards. So there's significant benefit to owning an asset like a house because it's something that appreciates, it goes up in value, and then you can use that to pay off all the smaller debts that you may have incurred over time. So consider using a HELOC if you own a home and you have some high levels of credit card debt, personal loans, medical bills, whatever you may have. Add a comment below, especially if you've ever had a HELOC. I'd love to hear from you. Like and subscribe to the channel, and I'll see you next time.